Very good morning, everyone. I am Ankit Kothari, committee member of ICAI Abu Dhabi Chapter. On behalf of ICAI Abu Dhabi Chapter, I'm taking this opportunity to introduce the eminent speaker for this session. Mr. Amit Sachdev leads the direct tax and legal consulting practice at MBG Corporate Services. He has 23 plus years of experience, including over 4 years in the GCC, across the domains of tax laws, accounting, foreign investments, foreign exchange control regulations, and corporate and business laws. Mr. Sachdev has advised various global corporates on their Indian ventures. With his rich experience in international tax and cross-border transaction, he advises corporates extensively on inbound investments and tax regulatory matters. Mr. Sachdev has advised clients on a wide range of issues from entry and exit strategies and transaction structuring to business. He has helped several global companies evaluate cross-border transactions as well as provided end-to-end assistance on deal structuring and tax and regulatory implications in numerous mergers and acquisitions. Mr. Sachdev is a regular speaker at seminars, events, and webinars across India, UAE, Malaysia, Singapore, and Japan. Prior to joining MBG, Mr. Sachdev managed a large and diversified portfolio at corporate office of Mitsui and Company in New Delhi. I welcome Mr. Sachdev on the stage with a loud applause, please.
A very good morning to all of you. I am thankful to the Chairman CA John George, Vice Chairman CA Krishnan NV, and entire Managing Committee of ICAI Abu Dhabi Chapter in organizing this symposium and inviting us to speak about basics of corporate tax. I am also thankful to the audience, the eminent speakers, and the entire CA fraternity in sparing their valuable time in attending this event. Trust me, your participation is overwhelming and speaks about your curiosity about the corporate tax which is proposed to be levied in UAE from June 23. My presentation would talk about a few important basics aspects of corporate tax, and prior to dealing with that, let me run through you on how the story and the way forward has been in terms of CT regulations in UAE. The genesis of proposed corporate tax regime goes back to the announcement made by Ministry of Finance on 31st January 22, when they announced introduction of federal corporate tax on business profits. This followed the release of public consultation document in which business communities and other stakeholders were asked to give their comments prior to release of the legislation. Needless to mention that this act in itself demonstrates a very participative approach of UAE government in seeking comments and making industry, chambers, business, trade houses, investors to be quite comfortable and ensuring a very conducive business environment for trade, investments, and business. UAE is a member of inclusive framework of OECD, and it's introducing CT regime to fulfill its commitment to the global minimum effective tax rate concept, which is proposed by Pillar 2 of OECD Base Erosion and Profit Shifting Project. The Federal Tax Authority has been designated as the administrative and enforcement authority for the entire CT regime. Implementation of corporate tax regime follows several other regulatory reforms in UAE. To begin with the announcement of VAT way back in 2018, ESR reportings, amendments in visa norms, announcements of several legislations in UAE, including amendments in various existing legislations. This in itself is an assurance that government aims in building up a very robust regulatory reform and framework in UAE. The proposed CT regime incorporates best practices and principles that are internationally known and accepted. The government has refrained from introducing any new concepts and aims at easier transition and also minimizing compliance burden for trade, business, and investors. In development of the CT regime, the Ministry of Finance has adopted few principles aiming to ensure efficiency, fairness, transparency, and predictability in execution process. The proposed law retains majority of distinct tax benefits of UAE, such as exemptions given for employment income, personal income earned by UAE and foreign individuals, or even those who are provided, and even those provided to free zone registered entities, including exemption for dividend and capital gains. This in itself ensures a visionary and commendable approach of the nation's leadership for creating and building a promising, stable, and growing economy, maintaining its attractiveness for the foreign investment. It merits that sufficient time has been given to business community in their readiness journey, in carrying out an impact analysis and planning their actions, decisions, including reorganizations of their structures to avail concessions, exemptions under the proposed legislation. CT regime proposes a progressive taxation where net profits in excess of AED 375,000 shall be taxed at 9%. Profits here shall mean accounting profits. Businesses who are having foreign branches shall be permitted to claim credit of taxes paid in foreign jurisdictions subject to certain conditions to prevent double taxation of the foreign sourced income. Businesses having multiple entities are permitted to form a tax group subject to certain conditions so that they can be considered as a single entity and they can have ease of compliance and administrative mechanisms for government itself. There is no requirement to pay corporate tax in advance or making any provisional filings. Businesses will have to file one single return and make the payment of tax in one installment itself. UAE CT regime won't bring any parallel tax on the income of individuals. Instead, the individuals who are engaged in business or commercial activity in UAE, whether by way of sole establishments or proprietorships, will be liable to pay corporate tax. The applicability will be judged by the fact that business activity of individual falls within the ambit of commercial license or any other similar permit in UAE. Employment income and any other personal income such as dividends, rental receipts will not be subject to tax. Likewise, for private or family trusts where beneficiaries are individuals having rent or dividend income will also not be required to pay taxes. General partnerships, unincorporated joint ventures, and associations of persons will not be considered as taxable entities, and their income will be taxed in the hands of members or persons running those institutions. Local entities incorporated in UAE and foreign entities having a permanent establishment in UAE or having a UAE-sourced income will be taxable. Similarly, companies incorporated in foreign jurisdictions but being controlled and managed in UAE will be within the purview of corporate tax. Limited liability partnerships or partnerships limited by shares will also be liable for corporate tax. Few entities have been exempted from the levy, either under automatic route or under a route in which they'll have to seek a specific approval. The list includes broadly: 1. Federal and emirate governments carrying non-commercial activities. In case government is carrying any commercial activity, it would be subject to taxable tax levy and taxable profits will have to be considered. Wholly owned government companies engaged in sovereign activities would also be exempted. Likewise, entities engaged in extraction and exploitation of natural resources which are already subject to emirate level taxation would also be exempted. Entities engaged in charities and public benefit activities would also constitute an exempted unit. Of course, there is a criteria that they'll have to seek an approval for that. Similarly, social security and retirement pension benefits and investment funds would also be exempted. There are special conditions which have to be complied with any investment funds to enjoy the exemption. Residency will be determining factor to judge if business profits will be taxable or not. Legal entities incorporated in UAE, individuals carrying business or commercial activity in the UAE will be considered as resident persons, falling within the ambit of UAE corporate tax. Any foreign company will also be regarded as resident person if it's effectively managed and controlled in UAE. And entities which are not residents in UAE will be considered as non-residents for the subject of taxation. All residents in UAE will have to pay tax on their global income, subject to a few exemptions. Individuals will have to pay tax on income earned from their business activities in UAE. Non-residents will be liable to pay tax only on profits earned from their permanent establishments and also on income which is having source or situs in UAE. Few illustrative items of UAE source income could include income earned from contracts performed in UAE or earned from assets located here. Permanent establishments shall mean place of business as mentioned in Article 5 of OECD. Likewise, let me deal with some categories of incomes which are now exempted, primarily dividends, capital gains, and foreign branch profits. UAE companies having shareholding in other companies and earning dividends are exempt from levy of tax on their dividend collections. The rationale behind this exemption is to avoid double taxation, one, in the hands of the company when it pays tax on their profits, and second, when the similar profit is distributed by way of dividend to the shareholders. The exemption will be available regardless of whether the company is located in mainland or in free zone. Similarly, UAE companies having shareholding in companies located in foreign jurisdictions will also not be required to pay tax on their dividend, but this is subject to two important conditions. One, their shareholding should be at least 5%, and second, the foreign company should also be subject to corporate tax of at least 9%. The PCD mentions at least 9%, and there is no clarity in terms of whether this is a mandatory aspect or there will be some leverage in times to come. Likewise, capital gains from sale of shares in both UAE and foreign companies will also be exempted from levy of tax. Two conditions would have to be met for this. One, the seller company owes at least 5% shareholding, and the foreign company again is subject to a corporate tax which is at least 9%. Subject to meeting these two criteria, and there are no changes being made in the final legislations, the intent is that capital gain incomes would be tax-free. Similarly, capital gains on disposal of shares in a free zone company will also be exempt from tax, subject to two conditions: that the free zone company is a holding company and substantially earns all its income from the entities meeting the similar participative criteria. So these subsidiaries in turn would also have to meet this criteria. This is slightly complicated. Let us hope that we'll have more clarity once the law is announced. Now let me deal with how the foreign branch profits have to be taxed. So UAE companies having branches in overseas countries, they have been given exemption on payment of tax. And there are two options which have been made available. One is to claim exemption of the branch profits completely. And second is to opt to pay tax on such profits after claiming credit of taxes paid overseas. Interestingly, the option would have to be exercised for all foreign branches. You will not have a right to choose some and leave few. And once the option is exercised, it will be an irrevocable option, which will mean that you will have no right to opt out of it. The other important condition is that foreign branch in itself shall also be paying sufficient level of tax in the jurisdictions in which they operate. So if you don't have any sufficient level of taxation in overseas, you will not be entitled for this exemption. Now, let me deal with how the taxable income will have to be calculated and how the tax liabilities would also be computed. Taxable income would mean the accounting profits as is coming from your financial statements, subject to, of course, certain adjustments. Few adjustments which have been listed in the public consultation document includes restriction on interest amounts. You will not be permitted to claim the entire interest expenditure. There's a threshold limit. Similarly, expenditures on revenue and capital expenditures would have to be classified very properly. Anything which is falling as a revenue expenditure would be permitted. Anything which falls under the capital expenditure umbrella would have to be capitalized, and probably concessions by way of depreciation would have to be availed. There's a restriction on entertainment expenses. 50% of your entertainment expenses would be eligible. Likewise, any unrealized gains or losses on capital items would also have to be adjusted. Exempted incomes in the form of dividend, capital gain, foreign branch would have to be dealt separately, and there will be adjustment from accounting profits. As I mentioned a little while ago, that UAE CT regime follows a progressive taxation. So there will be no tax on income up till 375,000 AED, and any income in excess of that amount will be taxed at the rate of 9%. The final tax liability would have to be reduced after claiming the credits paid overseas in case you have, to prevent the double taxation of the foreign sourced income. Few important administrative aspects for CT regime, broadly 4 I have listed. 1, every taxable entity business will have to take a registration from FTA. 2, tax returns would have to be filed annually within 9 months from the end of first taxable period. So if your taxable period starts, say, from 1st of January 24, ends on December 24, then by September 25 you will have to file your tax returns and make payments. FTA, like any other country, will have the right to scrutinize and assess the tax return which is filed by a business enterprise. Filing of return would follow the process of assessment, scrutiny, examination by FTA. Whereafter an assessment order or a scrutiny order would be announced, and every business who is not satisfied with the contents of order will have a right to dispute on same. The legal remedies and rights would be available to challenge the contents through an appellate mechanism, which is, of course, will be subject to certain prescribed conditions in the law to be announced. Transitional rules are also very important aspects. Businesses are not required to restate their balance sheet upon entering CT regime. So the closing balance of the financials on the immediately preceding period would become then opening balance for the period when you enter the tax regime. Businesses will have to follow proper accounting policies, practices. They must adhere to all cut-off procedures to ensure that there are no transitional issues in terms of booking of expenditures, revenues, which is a quite standard practice in any matured tax jurisdiction. Last but not least, a very brief on concept of POEM, which I've already talked in my early part of the presentation. What would constitute a place of effective management is very important, especially for those foreign companies who have a base here, but they essentially are paying taxes overseas. So what will determine their place of effective management? Any business shall be said to be controlled and managed if its directors or its key managerial personnel are operating out of UAE. Important decisions for running and controlling businesses are taken in UAE. Negotiations and signing of contracts also take place in UAE. Core business functions are managed from UAE, or the business unit heads are operating out of UAE. So this will constitute the POEM. So if you have a POEM here in UAE, there will be a tax exposure for you. Broadly, with this I end my presentation, and I am thankful for all of you for giving me a patient hearing. Thank you very much.
Good morning, everyone. This is CA Rajesh, Managing Committee Member of ICAI Abu Dhabi Chapter. I would like to thank Mr. Amit Sachdev for his informative and engaging session on the basics of corporate taxation. I would like to invite Vice Chairman CA Krishnan, Past Chairman CA Rajesh Shah, to present a memento to the speaker.